Ever wondered if you could get a regular paycheck from your investments even after retiring? That's where systematic withdrawal plans come in. They allow you to withdraw a fixed amount from your mutual fund investments at regular intervals, monthly, quarterly, or even yearly, without having to sell everything at once. But how exactly do they work? What are the tax complications? And can they really help you beyond just retirement planning? Let's break it down. What are systematic withdrawal plans and how do they work? A systematic withdrawal plan is a strategy in which you withdraw a set amount from your mutual funds investments on a regular basis. This is totally opposite to systematic investment plan, which allows you to investing small amounts on a regular basis. So this is how it works. You make a lump sum investments in your mutual funds, preferably a debt or a hybrid fund. You set up an SWP to withdraw a set amount at regular intervals. The fund redeems the units from your investment and deposits the proceeds into your bank account. The good part here is that your investment continues to grow as you withdraw gradually. Let's look at an example. Let's say you have 10 lakhs in savings. Instead of letting it sit idle in a bank account, earning minimal interest, you invest in a mutual fund that generates an average 8% annual return. Now, set up an SWP to withdraw 10,000 per month as cash flow. Here's what happens over time. Your initial investment remains invested, continuing to earn 8% annually. The 10,000 you withdraw isn't just from your capital, it's partially covered by the returns your investment generates. If you withdraw a sustainable rate lower than the fund's growth rate, your money lasts longer while still compounding over time. So how this beats just saving? So if you had kept the 10 lakhs in a savings account with no growth, you would eventually run out of money after 100 months, that is 8.3 years. If you assume a 3% return, the 10 lakhs would run out even before 10 years. But with a well-managed SWP, your investments keeps generating returns, allowing you to withdraw for a much longer period, possibly even indefinitely if planned right. Now let me tell you how your returns are taxed in SWP. Let's say you invested 5 lakhs in an equity mutual funds on Jan 1st, 2025 and started a systematic withdrawal plan to withdraw approximately 10,000 every month. In February, say the market went up by 10%, so the net asset value per unit rose from 100 to 110. To withdraw 10,000, the fund sells 91 units for you. How much do you pay tax? Your initial investment in those 91 is 9,100. Withdrawal value is 10,000, so capital gains is on 900. Since you withdrew within a year, this is a short-term capital gain and taxed at 20%. Tax to be paid rupees 180, that is 20% of 900. Not bad, right? But what if the market falls instead of rising? If the market drops by 10%, the NAV also falls to 95. Now to get 10,000, the fund needs to sell 105 units instead of 91. Your initial investment in those 105 units is about 10,500. Withdrawal value is equal to 10,000. Capital loss is equal to 500. Here's the good news. The capital loss can be adjusted against the capital gains. So if you were to have gains elsewhere, you can actually reduce your tax liability. After 1 year, any withdrawals are taxed at long-term capital gains at just 12.5%. But wait, there's a 1 lakh tax exemption. If your total long-term capital gain in a year is below 1 lakh, you pay zero tax. If it's above 1 lakh, you pay only 12.5% on the excess amount. Now that you have a perspective about equity mutual funds, let's look at debt mutual funds. Debt mutual funds work a bit differently. If you withdraw money, the gains are added to your income and taxed as per your slab rates. For example, if your income is 20 lakhs plus, your mutual funds are taxed at 30%. But if you are in a lower tax bracket, the tax will be lower. So debt funds are not as tax efficient as equity funds, especially for long-term wealth building. But wait, you can pay less tax on mutual fund profits as well. Follow these steps. Hold equity funds for more than 1 year and just pay 12.5% tax or nothing if your gains are under 1 lakh. Use a systematic withdrawal plan instead of lump sum withdrawals. Spreading withdrawals over time reduces short-term tax liabilities as well. Offset losses against gains. If you make a loss in one investment, use it to reduce tax on the profits from another. You can even carry forward to adjust in future years as well. Many people still rely on fixed deposits for stable returns. But when it comes to taxation, systematic withdrawal plans in mutual funds can be a smarter alternative. Here's why. FD is fully taxable as per your income tax slabs, 10, 20, 30%, whatever it is. If you don't withdraw the FD interest, the bank deducts TDS at 10 or 20%. If you are in the 30% tax bracket, your FD interest will also be taxed at 30%, reducing your effective returns significantly. Let's take an example. You invest 10 lakhs in an FD at 7% interest every year. You earn 70,000 annually. If you are in the 30% tax slab, you pay 21,000 as tax. Hence your post-tax return is 49,000 instead of 70,000. But with a systematic withdrawal plan, you don't pay tax on full amount that you withdraw, but only on the capital gains, that is a profit portion. If you withdraw 10,000 per month, only a small portion is considered as capital gains, rest is your own money. If you withdraw after 1 year, your gains are taxed at 12.5%, and if total gains are less than 1 lakh, it's tax free. Let's take an example. You invest 10 lakhs in an equity mutual funds and set up a SWP of 10,000 per month. Assuming 8% annual growth, your first withdrawal consists of 9,200 from your own investments and only 800 as profit. If withdrawn after 1 year, the 800 profit is taxed at just 12.5%, which is 100 rupees of tax only. Unlike FD, you don't pay tax on the entire 10,000 rupees. Also, to add more value to the reason, FD interest rates are often lower than inflation, meaning your real returns are always negative. Meanwhile, mutual funds have a potential for higher returns even after tax, helping you to beat inflation over time. So before jumping into an SWP, consider these following factors. Choose the right fund type. Your choice of mutual funds depends on how long you plan to keep the money invested. Equity funds are best for long-term withdrawals, that is 5 years plus, due to high growth potential. Equity funds invest in stocks, which means you can get high returns 10-12% over the long run. If you don't need the money for at least 5 years, equities have time to grow, recover from the market ups and downs, and give you inflation beating returns. Whereas debt hybrid funds are more stable, suitable for short-term withdrawals. These funds invest in bonds, fixed investment securities, and some stocks for hybrid funds. They are less volatile than equity funds. If you need to withdraw money within 1 to 5 years, these funds ensure your capital is safer with lower risk. These debt funds typically give a return of 5 to 8% per year, so they're good for steady withdrawals. Set a sustainable withdrawal rate. If your investment earns 8% return but you withdraw 12% annually, your funds will deplete quickly. A sustainable withdrawal rate, say like 4 to 5% annually, ensures longevity. Inflation adjustment. 50,000 today won't be enough in 10 years due to inflation. If inflation is at 6% per year, your 50,000 will feel like just 28,000 in a decade. Hence, to adjust for this, plan for increasing withdrawal amounts over time. Instead of a fixed 50,000, adjust withdrawals by at least 5 to 6% every year. And make sure you reinvest some returns. If your investments are growing at 10% per year, but you withdraw only 6 to 7%, your capital will keep growing, ensuring you never run out of money. Tax impact. If possible, structure withdrawals to minimize tax liability. Avoid frequent large withdrawals that trigger higher taxes. Always practice tax harvesting. Moving on, let's address another important question: how SWPs can help beyond retirement. While SWPs are commonly used for retirement income, they can serve other financial goals too. Second income source. If you have a lump sum like from a bonus or property sale, SWPs can generate a steady income without locking your money in FDs. Funding children's education. Instead of withdrawing all at once, you can use an SWP to cover yearly tuition fees. Early retirement planning. Not just for those in the 60s, you can start SWPs in your 40s or 50s for passive income. Tax efficient alternative to salary. Freelancers or business owners can use SWPs to withdraw from investments in a tax-friendly way. Now, after talking about everything about the SWPs, let me tell you a wise way of withdrawal. One popular withdrawal strategy is the 4% rule, which suggests you can withdraw 4% of your investment portfolio annually, and your money should last for 30 years at least, assuming a 7 to 8% return every year. For example, if you have a crore portfolio, you can withdraw 4 lakhs per year or 33,000 per month and sustain withdrawal for decades. But does the 4% rule work for everyone? In India, inflation rates and market volatility are different from Western economies, so the 4% rule may need adjustment. Some experts suggest a 3.5% withdrawal rate for Indian investors. Hence, the rule can be used as a general rule of thumb. SWPs are a great tool to generate passive income, whether for retirement or for other financial goals. The key here is to choose the right fund and a sustainable withdrawal rate and plan for tax efficiency. If you're looking for a steady, tax-friendly income stream without completely selling your investments, SWPs might just be the right solution for you. Would you consider SWPs in your investment strategy? Let me know in the comments below. That's it from me. I'm Nikhil Burgess. Share this video and subscribe to learn how to make your finances less tricky with Finicky.